From my point of view, in geopolitics, the world is approaching a massive showdown. We've seen that the relations between the world's political power centers are increasingly being strained. So we're basically seeing a showdown between the saturated, established Western countries and the hungry upstarts in emerging markets. The ever-increasing economic and political importance of emerging market countries has been apparent for many years. Dissatisfaction with the prevailing international economic order seems to be growing daily. Various international institutions, largely dominated by the West, are being called into question, while the alliance forming around the BRICS nations seems to be experiencing strong growth. At the beginning of 2024, 4 new member states were admitted to the BRICS coalition: Egypt, Ethiopia, Iran, and the United Arab Emirates. Saudi Arabia, which is gaining geopolitical influence, is also likely to join the alliance, but has not yet officially confirmed its acceptance of the invitation to join BRICS+. Should Saudi Arabia accept, BRICS+ would account for 43% of global oil production and 44% of global oil reserves. Well, at the forefront are basically the collective West under the leadership of the US on the one side, and on the other side, there are China, Russia, and this bloc that is forming around those two heavyweights on the other side. We're seeing that a considerable number of emerging market economies associate themselves with China and Russia nowadays through organization, for example, the BRICS or the Shanghai Cooperation Organization. It is precisely these states that have been increasingly building up gold reserves and reducing US dollar reserves since 2008. This trend accelerated again as a result of the sanctions against Russia, as we have projected in the In Gold We Trust Report 2022. Emerging market countries have taken careful note of the militarization of money and are now trying to reduce their dependence on the US dollar. Gold is one of the few neutral and liquid reserve currencies available in this political environment. If you have a look at this chart, you can see that in 2024, around half of global GDP will already be generated by emerging markets, compared to only 19% in 2000. 2/3 of global GDP growth in the last 10 years has been generated by emerging markets. So the majority of emerging market economies have a much greater demand for gold, a much higher gold affinity than industrialized nations. And this, from our point of view, will feed into long-term growth in demand for gold. Or, as Louis Vincent Gaff once called it, gold is a low beta proxy for emerging markets' success. For years, the BRICS+ countries have had a considerable trade and current account surplus with the West. A steadily increasing share of gold in the currency reserves of emerging economies is the manifestation of this development. This is quite similar to the situation after the Second World War, when Europe, especially Germany and France, successively increased their gold reserves as a result of high current account surpluses. In contrast, US gold reserves fell to almost a quarter of its highest point, or just over 8,000 tons, as a result of the gold drain. So while the US experienced a gold drain in the 1960s, there are currently signs of a gold gain in the emerging markets. The East is clearly on the move. China has made significant efforts to push the goal of renminbi internationalization by forging key agreements with Saudi Arabia and the United Arab Emirates. It has advocated the use of its currency in oil and gas trade and expanded its Belt and Road Initiative to include new countries and projects. The renminbi's share of trade settlement, long stagnant below 1% of global transactions, has soared in recent months, as indicated by SWIFT. The drumbeats of Eastern power echo in the sands of Arabia as well. The United Arab Emirates has begun reaching out to trade partners, suggesting the use of local currencies to settle oil and gas transactions. And Saudi Arabia has expanded trade with China, prioritizing the use of renminbi instead of US dollars. But this chart shows that despite what many believe, the greenback is actually not losing market share as a payment and settlement currency. The latest transaction data from SWIFT basically indicates that the prominence of the US dollar in international payments has reached unprecedented levels. Last summer, greenback-related trades surged to an all-time high of 46%, a significant increase from 3 years ago. So we should talk perhaps a little bit more about euroization before de-dollarization actually happens. According to the 2022 Triennial Central Bank Survey by the Bank of International Settlements, the US dollar was involved in approximately 88% of global FX transactions. This proportion has remained consistent over the past 2 decades. In comparison, the euro accounted for 31% of FX transactions, a decrease from its peak of 39% in 2010. The euro has also fallen in other areas. The share of foreign debt issued in euros was 27% in 2005 and fell to 20% in 2022. The percentage of foreign currency transactions in euros fell from 38% to 31%. And the portion of foreign exchange reserves held in euros fell from 24% to 20% in that period. We have painted out in our In Gold We Trust report 2023, which was titled Showdown, that the freezing of Russia's currency reserves by the US and the EU has highlighted to the world that the redemption of US dollar or euro-denominated reserves may not be guaranteed. And from our point of view, this erosion of trust is very, very hard to reverse. The potential weaponization of gold could have significant repercussions on global cohesion if a universal emergency payment method at the international currency level is to be implemented. Other nations have already expressed discontent of the practice of weaponizing the US dollar, and that trust has subsequently eroded. This has contributed to a decline in the US dollar's share among global reserves from 70% to 58% over the past 2 decades. Amidst the push for de-dollarization, the Middle East emerges as a pivotal player, despite the absence of any domestic alternative to rival the greenback. The past year has seen a clear move by China to join forces with Saudi Arabia, and it appears to be working in their mutual favor. During a meeting with Arab leaders in December 2022, President Xi Jinping announced China's intention to purchase oil and gas using renminbi. So this strategic move is basically in alignment with Beijing's objective to promote its currency on a global stage and to diminish the dominance of the US dollar in international trade. However, the majority of Saudi Arabia's assets and reserves are still denominated in US dollars, including over 110 billion in US treasuries held by Riyadh. Since 2020, Russia's initiative to reduce dependence on US assets has resulted in gold comprising a larger portion of its 480 billion international reserves than the US dollar. Initially, Russia and China's strategy to phase out the use of dollars for commodity pricing, cross-border settlements, and most foreign exchange transactions was primarily defensive. They allowed the US to take the lead in geopolitical maneuvers and strategic missteps. However, the imposition of sanctions against Russia dramatically altered the situation. Facing pressure, Putin has been compelled to adopt a more confrontational approach. Since the year 2000, the Middle East has approximately doubled its gold holdings, underscoring the region's growing significance in the gold market. This trend reflects several factors, including the region's cultural affinity for gold as a store of wealth and a symbol of prosperity, as well as strategic decisions by central banks to diversify their reserves amid geopolitical uncertainties and economic volatility. In this year's In Gold We Trust report, we've got a special chapter about the gold market in the United Arab Emirates. Dubai, for example, is responsible for 25% of global gold trade. This trend is the true de-dollarization that we are speaking of, or at least the first stage of it. The divestment from US treasuries is the first nail in the US dollar's coffin, eliminating the easy source of offshore funding that America has benefited from for the last 50 years, since President Richard Nixon closed the gold window and Henry Kissinger flew to Saudi Arabia to help give birth to the petrodollar. So overall, from our point of view, this should be really worrying for US policymakers, as it basically means that they will have to find other sources of demand for US treasuries. Now, It can be achieved with the means of financial repression, a topic that we have written about and discussed at length in the last couple of years. Or we might see that the Federal Reserve will start another round of quantitative easing, or perhaps they will give it another name, a quite sophisticated abbreviation probably. But it is really obvious that at some point we will see that the US government will have to step in and find a new alternative source of demand for US treasuries. So to us, it is actually no surprise that foreign central banks are on a rapid gold buying spree. Gold was a shunned asset during the Great Moderation. The yellow metal collapsed from a massive 80% of foreign reserves to only 15% within 3 decades. However, we're seeing that a so-called heel turn is now taking place. For the very first time since the late 1980s, gold has rotated back into becoming a favored asset among central bankers, no longer vilified. Now, could these foreign officials sitting in central banks, especially in emerging markets, be hedging against inflation? Or are they hedging against a devaluation of their own currencies? We'll see. However, the more worrying implication is that US treasuries and perhaps the US dollar itself are losing reserve status, and gold is returning to its rightful spot as the global neutral reserve asset. If this is true, it will have massive significance for the gold price and the funding mechanism of the treasury itself. Gold serving as a neutral reserve asset doesn't just fix Triffin's dilemma, it obviates it completely. Without the single central issuer of the global currency, there is no dilemma because there is no stark contrast between interior versus exterior demand and supply. The TINA doctrine would now be replaced by TIA. There is an alternative, and the alternative is gold. To expand on the Triffin dilemma, in 1959, a Belgian economist by the name of Robert Triffin gave a presentation in front of the US Congress on what he saw as a fatal flaw in the Bretton Woods global monetary system. The flaw he presented came to be known as the Triffin dilemma or the Triffin paradox, and it would, he asserted, destroy Bretton Woods over a long enough time frame. The Triffin dilemma boils down to this. As the US dollar is the global reserve currency, there is international demand for it. These funds are needed to settle global trade, held as reserve balances by central banks, and to satisfy offshore dollar debts. All these countries borrow, save, and trade in a currency that they cannot print. But actually the implications of this dilemma are extensive. Because in order to satisfy the international demand for the reserve currency, the issuing country must be prepared to perpetually export more of its currency than it recoups through trade surpluses. And this can lead to an erosion of confidence in the currency if markets perceive that the balance between international liquidity provision and domestic economic stability is not being effectively managed. The US must choose whether or not to satisfy this demand. If they elect not to, a deflationary crisis could develop, as there would not be enough US dollars to satisfy global trade and finance needs. If they do, then the constant outflow of greenbacks would create more dollars than is otherwise justified, eventually breaking the Bretton Woods gold peg of $35 an ounce. Triffin gravely warned Congress that this outcome was essentially inevitable, and it was. From our point of view today, gold can still replace US treasuries as the de facto reserve asset. In this scenario, the trend that we saw over the last few years will probably accelerate rapidly. Foreigners will be dumping treasuries, and they would replace them with gold reserves, held in their own vaults, demanding physical ownership rather than custody. So the self-balancing nature of the gold standard would actually return. Any country issuing too much paper currency versus their gold would see their reserves being drained, eventually causing devaluation and restrictive monetary policies to correct the issue. From our point of view, a gold revaluation would then be forced, which could actually be very, very profitable for central banks that hold a significant portion in something called a gold revaluation account. As our friend Jan Nieuwenhuis lays out, this has already been done several times in the past. For example, by the Netherlands in the 1930s, Italy in 2002, and it can also be used to recapitalize a central bank, such as Switzerland did in the year 2000. The gold price level would then be dependent on each country's particular M2 composition compared to its real gold reserves. This possibility could explain why foreign central banks are gobbling up the precious metal in record amounts. So they are preparing for a reset of the global monetary system and the reintroduction of gold as the neutral reserve asset, replacing $7 trillion of US Treasury bonds. Bullishness in this case for the gold price cannot be understated. Now, ladies and gentlemen, even if this scenario sounds very far-fetched, one thing is clear. The East is back in the driver's seat for gold markets. The marginal gold buyer is not in the Western world anymore, but rather in the Eastern world. Eastern demand has begun pushing prices up and has reignited the bull market in precious metals, long thought dead by dollar proponents and bond traders. For an in-depth analysis of de-dollarization and the rise of BRICS, check out this fantastic debate between Louis Vicent Garve and Brent Johnson, two esteemed economists and geopolitical experts. Just click the card on your screen to begin watching.